They surrender. After 40 years of war, after 4 decades of suppression, manipulation, and price smashing, after the Hunt brothers were destroyed in 1980, after the $50 crash in 2011, after the spoofing scandals of 2020, the enemy has finally laid down their weapons. Ladies and gentlemen, Asian guy here, for the last 10 years, every silver investor on this planet has told the same story. We whispered it in forums. We shouted it on YouTube. We wrote about it in newsletters. The story was simple. Silver will never be free until the banks stop shorting it. We knew that there was a cartel, a group of massive U.S. bullion banks, led by the likes of J.P. Morgan and Citi, who stood like a stone wall against the rising price of silver. Every time silver tried to fly, they sold paper contracts. They didn't have to crash the price back down. They were the suppressors. But this morning, the war ended. And it didn't end with a bang. It ended with a PDF file released by the U.S. government. I have the bank participation report from the CFTC right here, and what it shows is a statistical impossibility. It shows a reversal so complete, so absolute, that it changes the fundamental mathematics of the silver market forever. For the first time in modern history, the big 4 U.S. banks have flipped. They are no longer net short. They are net long. Do you understand the gravity of what I just said? It means the suppressors are no longer trying to stop the price from going up. They have switched sides. They have effectively front-ran the entire market. They are now positioned to make billions of dollars, not from silver crashing, but from silver exploding. But here's the twist, the dark twist that makes this the most dangerous financial moment of our lives. If the U.S. banks sold their short positions, who bought them? For every seller, there must be a buyer. If J.P. Morgan got out of the way of the train, who did they tie to the tracks? The report tells us that answer too, and it is terrifying. J.P. Morgan and the U.S. giants have handed the death bag, a short position of over 215 million ounces, to the foreign banks, to the Europeans, to the Canadians, to the Asians. They trapped their competitors in the mother of all short squeezes, and then they flipped the switch to long. In this documentary, we are going to tear this report apart line by line. We are going to look at the trap that was set back in October. We are going to analyze the historical data to show you why this is the endgame signal for $100 silver. The banks stopped fighting. Now they are riding the rocket with us. Let's look at the receipts. Because in a world of fake news and AI rumors, the only thing that matters is the official government data. Every month, the Commodity Futures Trading Commission, CFTC, releases a report called the Bank Participation Report. It tells us exactly what the biggest banks in the world are doing in the futures market. For years, if you opened this report, it looked like a crime scene. You would see that U.S. banks holding a massive net short position, usually 20,000, 30,000, sometimes 40,000 contracts short. That net short position was the ceiling. It was the invisible hand that slapped silver down every time it got close to $30 or $40. But look at the report for December 2025. Let's read the lines together. U.S. banks reporting 5 long positions, 18,611 contracts. Short positions, 17,138 contracts. Now do the math. 18,611 minus 17,838. That leaves a net long position of 773 contracts. It's a small number, isn't it? 773 contracts. It doesn't look like much. But in the world of high finance, this is a seismic shift. This is like finding out that the iceberg has started moving away from the Titanic. For decades, this number was negative, deeply negative. It represented billions of dollars of bets against silver. Today, it is positive. This means that as a group, the most powerful financial institutions in the United States, the ones with a direct line to the Federal Reserve, the ones who control the plumbing of the global economy, are now betting that silver goes higher. They have cleared their books, they have covered their shorts, and they have bought enough long contracts to ensure that when the price hits $70, $80, $100, they participate in the upside. Why does this matter? Because of incentive. When a bank is net short, their incentive is to smash the price. They make money when silver falls. They lose money when silver rises. So they use their algorithms, their high-frequency trading, and their spoofing tactics to keep a lid on the market. But when a bank is net long, their incentive flips. Now they want the price to rise. Now they want to panic. Now every time silver jumps $5, they book a profit. The paper ceiling has evaporated. The whale that was swimming against the current has turned around and is now swimming with the current. And when a whale swims with the current, you get a tsunami. To understand why this flip is so historic, you have to understand the war we have been fighting. This isn't just about money. This is about a multi-generational struggle for fair price discovery, Go back to 1980. The Hunt brothers tried to corner the silver market. They bought physical. They bought futures. They drove the price from $6 to $50. What happened? The exchanges, controlled by the banks, changed the rules. They announced liquidation only. They forced the Hunts to sell. They crashed the price to $10 and bankrupted the only people who tried to free the market. Go forward to 2011. Silver hits $50 again. It looks unstoppable. The dollar is crashing. What happens? A mysterious series of margin hikes. 5 margin hikes in 9 days. The banks slammed the doors shut. The price crashed to $26 in weeks. Go forward to 2020. JP Morgan is fined $928 million by the Department of Justice for spoofing. They admitted to placing fake orders to manipulate the price of precious metals. They admitted it. It wasn't a conspiracy theory, it was a criminal confession. For 40 years, the U.S. banks have acted as the guardians of the status quo. They were the gatekeepers who ensured that silver, the people's money, never threatened the dominance of the U.S. dollar. So why did they stop? Why, in December 2025, did they suddenly decide to flip the script? Did they find religion? Did they suddenly develop a moral compass? No, they flipped because they are predators. And predators don't fight battles they can't win. They looked at the physical market. They looked at the solar panels. They looked at the Samsung batteries. And they realized that this time, the short game was suicide. If they stayed short in 2026, they would be wiped out. The physical demand is too strong. The shortage is too real. You cannot suppress a beach ball underwater forever. Eventually, the pressure shoots it to the moon. So they did the only thing a smart predator would do. They stopped fighting the beach ball, and they decided to buy the beach ball. But here is where the story gets truly dark. Because if JP Morgan isn't the villain anymore, who is? Who's taking the loss? Because in the futures market, it is a zero-sum game. If the US banks are long, someone else must be short. And that brings us to the trap. In the world of high finance, there are no friends. There are only counterparties. When JP Morgan or Citi decides to exit a massive trade, they don't just close their laptops and walk away. They need someone to take the other side. They need a bag holder. If you're dumping a toxic asset, or if you're exiting a dangerous short position, you need to find someone foolish enough, or desperate enough, to buy what you're selling. So when the US banks spent the last 3 months frantically covering their shorts, buying back contracts and flipping to net long, who was on the other side of that trade? Who stepped into the path of the steamroller just as the driver jumped out? Let's go back to the report. Non-US banks, reporting 17, short positions, increased by 43 to 84 contracts. While the US banks were running for the exit, the non-US banks, the giants of Europe, the heavyweights of Canada, the state banks of Asia, were doubling down. They didn't just hold their shorts, they increased them. They absorbed the entire short position that the US banks shed. We are talking about a total net short position held by foreign banks that now exceeds 215 million ounces of silver. Let me put that number in perspective for you. 215 million ounces is 25% of the entire annual global mining production. These foreign banks are effectively shorting 1/4 of the planet's yearly supply of silver, and they are doing it at a time when the price is at an all-time high, 67. The physical market is in a deficit. Their biggest allies, the US banks, have deserted them. This is not a hedge. This is a suicide pact. Why would the US banks do this? Why would they hang their European counterparts out to dry? You have to understand the geopolitical game being played here. The US dollar is under attack. The BRICS nations are building alternative payment systems. Gold is hitting record highs. The Western financial system is straining under the weight of debt. In this environment, it is every bank for itself. The US banks realized that the silver suppression game was ending. They knew that if they kept fighting the physical reality, they would eventually blow up. So they made a calculated decision. They decided to sacrifice the foreign banks to save themselves. By flipping long, the US banks have essentially weaponized the silver price against their rivals. Think about the mechanics of what happens next week. If silver goes to $70, the US banks make money. But at $70, the foreign banks, sitting on 215 million ounces of shorts, are facing billions in margin calls. They will get a phone call from the exchange. Post more collateral. Send us more cash, or we liquidate you. If silver goes to $75, the pain becomes unbearable. The foreign banks start bleeding capital. They have to start selling other assets, stocks, bonds, gold, just to keep their silver shorts open. And who is squeezing them? Who is driving the price up? We are. The physical stackers. Industry is. Samsung and solar. And now, the US banks are. JP Morgan is sitting there holding their new long contracts, watching the price rise, and watching their European competitors squirm. They have zero incentive to stop the rally. In fact, they have every incentive to push it harder. They want to force a margin call cascade. They want to force the foreign banks to panic buy. Because when a bank with a 215 million ounce short position finally breaks, when they finally tap out and say, I surrender, they have to buy back 215 million ounces in a market that has no metal. That is the moment the chart goes vertical. That is the moment you see the $50 day or the $100 day. It is a financial execution. And the US banks are the ones pulling the lever. But wait, it gets worse. The report I showed you, the CFTC report, only covers the COMEX futures market. That is the lit market, the visible market. But beneath the surface lies the dark market, the over-the-counter OTC derivatives market. This is where the real monsters live. Swaps, forwards, exotic options. Deals done in private between banks, off the books, unregulated and opaque. Estimates suggest the OTC silver market is 10 times larger than the COMEX. If the US banks have flipped net long on the COMEX, what have they done in the OTC market? We can't see the data, but we can read the footprints. If they are terrified enough to flip their public positions, you can bet your life savings that they have unwound their private positions too. John Lindau, a brilliant analyst who tracks these flows, asked the critical question this morning. Have the major 5 US bullion banks also closed out their trillions in silver short positions in the derivatives market because they know the final end game has arrived? The answer is almost certainly yes. They are scrubbing the books. They are de-risking. They are preparing for a reset event. This explains the volatility we saw last week. This explains why platinum saw those weird shenanigans in the vault data. This explains why lease rates are soaring. The banks are frantically untangling themselves from decades of suppression schemes because they know the dam is about to break. And here is the most telling signal of all. They aren't spoofing anymore. Look at the chart for the last 3 days. Where are the waterfall smashes? Where are the 9 a.m. dumps? Where are the massive red candles that appear out of nowhere to kill a rally? They are gone. For the first time in years, silver is trading. Normally, it goes up. It consolidates. It goes up again. Why? Because the smasher isn't smashing anymore. The smasher is buying. When the biggest manipulator in the market stops manipulating, that is when you know the trend is real. That is when you know this isn't a fake out. This is a jailbreak. So let's assemble the full picture. We have discussed the physical reality in previous videos. Samsung buying mines. Solar eating 30% of supply. JP Morgan owing China 129 million ounces. That was already enough to send silver to $100. That supply-dollar demand imbalance was a powder keg waiting for a spark. But now we have the financial reality to match it. The banker flip is the spark. It removes the last line of defense for low prices. It removes the short cap. And it turns the US banks from enemies into allies. I want you to think about what happens next week when the markets open. The algorithms that track this CFTC data, the algos that run the hedge funds, they are going to read this report. They are going to see US banks net long. And what do you think their code is going to do? They are going to buy. They are going to pile in. They are going to front run the squeeze on the foreign banks. We are looking at a feedback loop from hell for anyone who doesn't own silver. Higher prices trigger algos to buy. Algo buying squeezes foreign banks. Foreign banks covering drives, prices higher. Higher prices trigger more physical hoarding. It is a self-perpetuating cycle to the upside. And the US banks, the architects of this system, are sitting back, smoking a cigar, and watching it burn. So here is the final verdict. We are no longer waiting for a catalyst. We are no longer waiting for a signal. The signal has arrived. When the US banks, the very architects of the paper silver scam, decide to flip net long, it tells you everything you need to know about what is coming next. They have seen the internal data. They know that Samsung is draining the mines. They know that solar is eating the inventory. They know that the vaults are empty. And most importantly, they know that their foreign competitors are trapped in a 215 million ounce short position that cannot be covered. They have positioned themselves for the end game. This is why $100 silver is no longer a dream. It is a mathematical inevitability. The paper wall at $50 is gone. The banker suppression at $60 is gone. The ceiling at $70 has been removed by the banks themselves. We are entering a vacuum, a zone of zero resistance. When the markets open on Monday, the algorithms are going to react to this report. The foreign banks are going to scramble for liquidity. The industrial buyers are going to panic. We are looking at a super spike, a move so violent and so fast that if you aren't already positioned, you will never catch it. Do not let them shake you out. You might see volatility. You might see wild swings. But remember who is on your side now. For the first time in history, you are trading with JP Morgan, not against them. They want the price to go up. They need the price to go up. The banks have flipped. The industry has panicked. The shortage is real. The era of cheap silver died this morning. Welcome to the era of price discovery. Hold your mettle, watch the fireworks, and do not blink. We at Currency Archive want to thank you for being part of this movement. I'll see you on the other side of $100.